1929, Joseph Kennedy stepped out of the market 6 months before the crash and made millions shorting the collapse. In 2008, Michael Burry bet against subprime mortgages and walked away with $700 million. And in 2025, the same blueprint is unfolding again. The same 4 stages, the same behavioral patterns, the same strategic positioning. What is surprising is not that this is happening. It is that most people still do not recognize the setup, even when it is repeating in plain sight. Let me break down what is happening right now that almost nobody is paying attention to. There is a recurring rhythm in financial history that emerges whenever markets stretch into extreme valuations. It is not luck, not magic, and definitely not random. It is a 4-stage sequence that seasoned investors execute with machine-like discipline, while the average person stays fully invested and rides the entire downturn to the bottom. A smaller group uses the cycle to multiply their wealth. They do not create the crashes, but they understand how leverage, psychology, and liquidity interact, and they position early for what becomes inevitable. This happened in 1929, when Kennedy exited near the top and then shorted the downward spiral. It happened in 2008, when Burry, John Paulson, and a handful of others made some of the greatest trades in history, betting against the housing bubble, and it is happening again today. Warren Buffett is sitting on a historic $325 billion in cash, more dry powder than any investor has ever held at one time. Jeff Bezos has quietly unloaded more than $13 billion in Amazon shares. Mark Zuckerberg has been selling Meta stock at record highs. Insider selling across corporate America is at levels we have not seen since 2007. The year before the last major collapse. And behind the scenes, select hedge funds are building asymmetric positions that only pay out explosively when markets fall apart. This is not conspiracy. It is public record. Strategy. It is the same script repeating. Once you understand these 4 stages and how they played out in 1929 and 2008, you will see exactly where we are in the cycle today. Stage 1 always begins 12 to 18 months before the crash. Sophisticated investors start exiting, not because they know the exact crash date, but because they recognize the environment. Valuations stretched, leverage exploding, and risk massively outweighing reward. This is when liquidity quietly rotates out of the system. In 1929, Joseph Kennedy was among the most successful speculators of the Roaring Twenties. He had made millions running stock pools, coordinated buying campaigns that pushed prices upward so insiders could unload near the top. By mid-1929, he held major positions across multiple stocks. Yet he began selling aggressively. The famous anecdote says he exited after receiving stock tips from a shoeshine boy. While colorful, that story oversimplifies the real reason. Kennedy understood leverage. He saw that margin debt had reached record highs. Investors were borrowing up to 90% of a stock's value. A mere 10% decline would trigger a cascade of forced selling. He knew the tower was built on sand, so he liquidated steadily through summer and early fall. He was not alone. Bernard Baruch, a veteran of previous panics, recognized identical warning signs. By September 1929, both Kennedy and Baruch had largely exited. The Dow peaked on September the 3rd. 7 weeks later, on Black Thursday, the sell-off began. They were already in cash while the rest of the market unraveled. Fast forward to 2008, and the same pattern appears with different players. Michael Burry, running Scion Capital, shifted from undervalued stocks to deep research on subprime mortgages in 2005. He obtained loan-level data, rare at the time, and discovered a ticking time bomb: teaser rate loans, unverified incomes, adjustable mortgages that borrowers could never afford once rates reset. The credit system was held together with duct tape. But ratings agencies still stamped these bonds au go. Burry realized the collapse was mathematically unavoidable. But he could not short mortgage-backed securities directly. So he did something unprecedented. He worked with Goldman Sachs and others to create credit default swaps tied to mortgage bonds. From 2005 to 2006, he bought billions in notional exposure. Month after month, he lost money on premiums, endured angry investors, and was called insane. But he was not wrong. He was early. Exactly where Stage 1 investors always stand. John Paulson reached the same conclusion. After analyzing housing affordability relative to incomes, he saw the bubble was detached from fundamentals. He launched a dedicated fund to short subprime and endured similar skepticism. Both men were executing Stage 1 between 2005 and 2007, leaving the consensus trade and positioning for collapse before the world caught on. The housing bubble peaked in 2006. Defaults surged in 2007. By 2008, the system was falling apart exactly as predicted. Which brings us to 2025. Who is in Stage 1 right now? Start with Warren Buffett. In his 2024 shareholder letter, he explained simply that he can't find anything attractively priced. That is polite code for everything is overpriced. So he sits on the largest cash pile in market history. Then we have Jeff Bezos unloading more than $13 billion in Amazon stock through 2024-2025. These are not routine diversification sales. They are sustained, strategic reductions. Mark Zuckerberg is selling Meta shares while the stock hits all-time highs. Even Jamie Dimon, the longest-standing CEO of America's biggest bank, sold shares for the first time in his entire tenure. Insider selling across major corporations is at pre-2008 levels. Executives know their real numbers, not the polished stories in earnings calls. They see slowing customers, weakening margins, and rising costs before the public ever hears a word. And they are selling into strength, exactly what Stage 1 looks like. The Buffett indicator, measuring total market value versus GDP, sits near 185%. Buffett has said that above 120% is dangerous overvaluation. At 185%, the flashing red lights could not be any brighter. The smart money is not guessing, they are preparing. Stage 1 is now complete. The people who understand cycles have already exited, not in a panic, but deliberately and methodically over more than a year. Retail investors continue buying dips and chasing AI euphoria, unaware that the very insiders building that narrative are selling to them. Stage 2 is next. Buying volatility insurance, 6 to 12 months before the crash. This is when sophisticated investors do not just step aside, They flip the playbook and start accumulating protection, put options, VIX calls, credit default swaps. These positions look expensive and unnecessary right before a downturn, but they become life-changing when everything breaks. Stage 2 starts before the public even senses danger, and based on everything we are seeing today, we are right on schedule. Before most people panic when volatility is low and insurance is cheap, that is when Stage 2 investors quietly make their move. Let me show you how this played out historically and what is happening right now. In 1929, the closest equivalent to modern volatility insurance was shorting stocks. After Kennedy and Baruch fully exited their long positions, they immediately began constructing short positions. Shorting is simple in concept, but psychologically difficult. You borrow shares you do not own, sell them at today's price, and hope to repurchase them later at cheaper levels. If you short a stock at $100 and it drops to $50, that is a $50 profit per share. But if the market keeps rising before crashing, as it often does, you endure months of losses. Most people can't tolerate that. Kennedy could. Throughout the summer and early fall of 1929, he quietly shorted multiple names. He paid borrowing costs effectively, the insurance premium, while the market climbed. But he knew the leverage in the system was unsustainable. When the crash began on Black Thursday, October 24th, the unwind was brutal. By month's end, markets were down 30%. By November, 50%. And within 3 years, the Dow had collapsed 89% from its peak. Kennedy's short positions paid out massively. Exact figures are not known due to the lack of disclosure rules at the time, but estimates place his profits between 15 million and 50 million, hundreds of millions in today's dollars. That was Stage 2, fully realized, pay small premiums during calm markets, collect an enormous payout when fear erupts. Fast forward to 2008. Burry's and Paulson's credit default swaps were textbook Stage 2 instruments. From 2005 to 2007, they paid 2 to 4% annually on their insured notional amounts. If you insured $100 million in mortgage bonds, you paid $2 to $4 million a year with no guarantee of any payout. For nearly 2 years, the housing market kept rising. Their funds showed losses. Investors revolted. Some demanded their money back, accusing Burry of losing his mind. Burry blocked withdrawals to prevent a forced liquidation because he knew the logic of Stage 2. Insurance is cheap when the world feels safe. You do not wait for panic. You buy the umbrella while the sky is blue. By late 2007, subprime defaults were accelerating. In March 2008, Bear Stearns collapsed in a government-engineered rescue. Lehman Brothers filed for bankruptcy that September, triggering global contagion. The swaps Burry bought for a few million suddenly paid hundreds of millions. Paulson's positions, tens of billions in notional insurance, exploded into a $15 billion gain. Compared to the payout, the 2 years of premiums were irrelevant, a tiny cost for a historic windfall. Bill Ackman executed a flawless Stage 2 in March 2020. As COVID fear hit, he purchased credit default swaps on investment-grade bonds considered extremely safe at the time. He spent $27 million. Within weeks, as markets dropped 35%, Those swaps paid $2.6 billion, a staggering 96-to-1 return in under a month. Ackman then used the profits to buy stocks at generational lows, precisely what Stage 4 is all about. Now, let us talk about 2025. Volatility insurance. Today includes put options, VIX calls, and credit default swaps on corporate or mortgage debt. Activity across all three has surged. The put-call ratio, normally around 0.6 to 0.8, has been elevated throughout 2024 and 2025. When it rises above 1.0, it signals more puts than calls are being bought. In simple terms, more investors are buying protection than gambling on upside. This is institutional hedging. VIX call options, which profit when volatility spikes, show unusually large purchases. Multi-million-dollar positions, focused on mid-2025 and late 2025 expirations. Retail traders do not buy VIX calls in this size. These are hedge funds and asset managers purchasing volatility insurance well ahead of time, positioning for a major shock window. Credit default swaps on commercial mortgage-backed securities have surged 500% in price since 2021. That means the market is pricing in a high probability of commercial real estate defaults. Someone is paying these inflating premiums because the math is undeniable. Offices are sitting 40 to 50% vacant nationwide. Refinancing is impossible at current interest rates, and billions in loans are coming due. When defaults hit, these CDs contracts will detonate in value, just like subprime did in 2008. Bill Ackman, not a man, has publicly mentioned adding protection in 2024. He does not have to disclose the exact structures, but when a billionaire hedge fund manager openly signals hedging strategies, it usually means he is already in position, not merely considering it. This is Stage 2 in real time. Buy protection before the crash is obvious. Pay premiums calmly while markets still seem strong. Wait for the inevitable. Now we move to Stage 3. Shorting specific sectors 3 to 6 months before the crash. This is the most aggressive phase. It is not about general insurance or sitting in cash. It is about targeting the exact weak points in the system. Stage 3 is not broad. It is surgical. In 2008, this was where Burry, Paulson, and others made life-changing returns. They did not just bet against housing. They identified the worst loans in the worst regions. Burry's loan-level analysis revealed where defaults would explode first: Florida, California, Arizona, Nevada. Adjustable rate mortgages resetting into unaffordable payments in 2007 and 2008. He shorted those specific tranches. When the defaults hit, those bonds became worthless, and his swaps paid at maximum. Paulson did the same, but also took direct aim at the financial institutions most exposed. In 2007 and early 2008, months before it was obvious, he shorted Bear Stearns, Lehman Brothers, and Washington Mutual. Wall Street analysts rated these stocks as buys. Everyone said these firms were too big to fail. Paulson saw their balance sheets and knew they were insolvent the moment their mortgage assets began falling. When Bear Stearns collapsed, he made a fortune. When Lehman went to zero, he made billions. Between 2007 and 2009, his funds generated roughly $2 billion across strategies, most of it from Stage 3, which brings us to 2025. Two sectors are flashing red: commercial real estate and regional banks, and smart money is building enormous short positions in both. Commercial real estate is entering a death spiral that the public still does not fully grasp. Remote work has permanently reduced office demand. Vacancy rates are at levels unseen in decades. Refinancing is impossible. Property values have collapsed, but the debt has not. Loans are expiring, banks are overexposed, and defaults are mathematically inevitable. And the hedge funds smell blood exactly as they did in 2007. Office buildings across the United States are sitting 40 to 50% vacant due to the permanent shift toward remote and hybrid work. Companies that once leased 5 floors now lease 2, sometimes 1. This is not a temporary post-pandemic adjustment. This is the new operating model of corporate America. These buildings were financed during the zero-rate era with mortgages at 3%, when money was essentially free, and lenders assumed occupancy levels would remain stable for decades. Now those mortgages are maturing and require refinancing at today's rates: 7%, 8%, sometimes 9%. That is triple the cost of capital. A building that barely generated enough rent to cover debt service at 3% becomes catastrophically unprofitable at 8%. Cash flows collapse. Loan covenants break. Even a well-run property becomes insolvent on paper, simply because the debt load is no longer serviceable. Values have fallen 40 to 60% in the hardest hit markets, because buyers know the math does not work. You cannot pay 2021 prices with 2025 financing costs when tenants are cutting space by half. So when owners can't refinance, and many can't, they default. They literally hand the building back to the lender because the mortgage exceeds the value of the property. That is what happened with Brookfield Asset Management in 2024. One of the largest real estate owners on earth simply walked away from 2 Los Angeles office towers, not because Brookfield was in financial distress. It was not. But because continuing to pay the mortgage on assets worth less than the debt is economically irrational. So they gave the keys to the lender and moved on. And Brookfield was just the beginning. Over $2 trillion in commercial mortgages come due in 2025 and 2026. A significant portion cannot be refinanced. Defaults will cascade. First slowly, then all at once, just like subprime did before 2008. And the institutions holding this paper, especially regional banks, will feel the shock directly. Hedge funds know this. They are already positioned. They have built massive shorts in commercial mortgage-backed securities CMBs, the same class of structured products that collapsed in 2008, except now backed by office loan instead of residential mortgages. CDs prices on these securities have exploded because sophisticated investors understand what is coming. When CRE defaults spike in late 2025 and 2026, these short positions will pay out like a second version of the Big Short. Next comes regional banks, the second major stage. 3 target, and we have already seen the preview. Silicon Valley Bank collapsed in March 2023. the second largest bank failure in US. History. Signature Bank failed the same week. First Republic failed a month later, sold to JP Morgan at a massive loss. New York Community Bank nearly collapsed in early 2024 and survived only through emergency capital injections. And none of this happened during a recession. These failures occurred simply because rising interest rates from 2022-2023 destroyed the value of long-dated bonds and mortgages on these banks' balance sheets. But the real ticking time bomb is their exposure to commercial real estate. Big banks like JP Morgan and Bank of America have diversified portfolios. CRE is a small slice of their loan books. Regional banks, however, are the CRE lenders of America. For many of them, 20%, 30%, even 40% of their loans are tied to office and retail properties. When those properties default, and they will, banks must recognize the losses. Those losses eat away regulatory capital. When capital falls below minimum thresholds, regulators seize the bank. Hedge funds know exactly which institutions are vulnerable. It is not mysterious. Banks disclose their loan books every quarter. Analysts can see which lenders have the highest concentration of CRE exposure, which operate in markets with the worst vacancy rates: San Francisco, New York, Chicago, Los Angeles. Short interest in these banks has surged. Major funds are betting these institutions won't survive the next cycle of defaults. Regulators complain that short sellers cause bank runs, but that is a misunderstanding or a convenient political narrative. Short sellers do not break banks. Insolvent balance sheets do. Short sellers simply acknowledge insolvency earlier than regulators admit it. This is stage, precision targeting, not shorting the entire market that is broad, expensive, and inefficient, but shorting the exact sectors and companies that will collapse first and hardest. The smart money is already here. They are paying borrowing costs, maintaining their positions, waiting for the avalanche. When CRE defaults spike in 2025, 2026, when regional banks fall in clusters, Stage 3 will pay off just as spectacularly as Paulson's and Burry's trades in 2008. And then comes Stage 4, buying at maximum fear. This is where the previous stages transform into generational wealth. Stage 4 occurs at the bottom, when fear is absolute, when the financial system feels like it might break, when people sell everything, not because they want to, but because they have to. This stage requires psychological strength almost no one has, and it requires cash reserves built through Stage 1 exits and Stage 2-3 profits. Look at history. In 1929, the crash was not a sharp drop and quick recovery. It was a multi-year collapse. The Dow fell 89% from its peak in 1929 to its trough in 1932. People were financially annihilated. But Kennedy and Baruch had cash. They bought real estate for pennies on the dollar. They bought distressed businesses at auction. They bought stocks trading below liquidation, value companies worth more dead than alive. By the mid-1930s, Kennedy was among the richest men in America. Stage 4 created the dynasty. In 2008-2009, the pattern repeated. The S&P 500 bottomed at 6 down 57% from the peak. Fear was everywhere. Headlines predicted a depression worse than the 1930s. But Buffett deployed capital aggressively. He injected $5 billion into Goldman Sachs in 2008, at terms so favorable they are legendary: 10% preferred dividends, plus warrants. That single deal returned billions. He did the same with Bank of America in 2011. Berkshire increased stakes in Wells Fargo, American Express, Bank. These positions doubled, tripled, quadrupled over the next decade. Stage 4 turned panic into extraordinary profit. Then there is Bill Ackman's legendary 2020 play. He spent $27 million on credit default swaps. They paid him $2.6 billion. But the real brilliance came after the payout. Ackman did not hide. He went on CNBC on March 18, 2020, and gave a fiery, apocalyptic interview. "Hell is coming," he warned. Markets plunged even further. But what he did not say on TV was this: he was already buying. While the public panicked from his words, he quietly moved into Stage 4, deploying the capital he had just earned from Stage 2 and 3. He bought stocks aggressively at pandemic lows. That combination, profit from protection plus buying at maximum fear, became one of the cleanest executions of the full 4-stage cycle in financial history. While Ackman was on CNBC predicting an economic apocalypse, his fund was already deploying the cash from his credit default swap windfall to buy companies he knew would surge once the panic faded. Starbucks, Hilton, Lowe's restaurant brands. Businesses with strong fundamentals that had been temporarily crushed by fear-driven selling. Within months, the Federal Reserve unleashed unlimited stimulus, igniting the fastest market rebound in history, and Ackman recorded the best year of his career. He earned a fortune on the collapse, and an even larger fortune on the recovery. That is Stage 4 executed flawlessly. Now think about what Stage 4 will look like in 2025 and 2026. The crash has not hit yet. We are still deep in Stage 3, the positioning phase, but history gives us a clear preview. When the break finally comes, whether triggered by cascading commercial real estate defaults, a tech sector implosion, geopolitical shock, or an unexpected catalyst, the panic will be overwhelming. Markets could fall 50 to 60%. Unemployment could spike into double digits. Regional banks will fail in clusters. News cycles will be saturated with catastrophic headlines. Politicians will panic. The Federal Reserve will be cornered, and that is the exact moment Stage 4 begins. Buffett's $325 billion in idle cash is not sitting still by accident. He is waiting for the moment when quality companies trade at prices he has not seen in decades. When the S&P 500 is slashed in half. When blue-chip businesses beg for capital, he will strike the same way he did during 2008. Preferred shares with double-digit dividends, warrants with enormous upside, equity positions at fire sale valuations, and entire companies acquired outright. When only a handful of players have liquidity, they write the terms. That is how fortunes multiply during crises. Private equity giants know this too. Apollo, Blackstone, KKR, Carlyle, they have been quietly amassing record levels of dry powder, not to invest today, but to unleash during Stage 4. When buildings are auctioned at 40 cents on the dollar, when corporate debt trades like distressed scrap, when foreclosed homes hit the market by the thousands, they will buy aggressively, hold patiently, and ride the recovery for a decade. The four-stage framework is not mysticism or insider privilege. It is simply human psychology repeating itself. Bubbles inflate. Leverage unwinds. Panic overshoots reality. And disciplined capital steps in when no one else can breathe. This exact cycle has replayed across centuries. Right now, in 2025, the pattern is unmistakable. Stage 1 is done. The insiders have already left. Buffett, Bezos, Zuckerberg. Corporate executives. They sold near the peak. Stage 2 is underway. Volatility hedges are being built. Options, swaps, tail risk insurance, all accumulating quietly. Stage 3 is happening in real time. Hedge funds are heavily shorting commercial mortgage securities and overexposed regional banks as defaults accelerate. The groundwork is set. And Stage 4, the moment of extreme fear, is approaching. The signals are already flashing. A recently normalized yield curve after a deep inversion. Commercial real estate distress. Accelerating regional bank failures. Insider selling matching pre-2008 levels. And valuation metrics far beyond historical danger zones. Every major recession indicator is fully aligned. If you cannot execute stages 1 through 3, like professionals do, you can still prepare intelligently for stage 4. Hold more cash than usual. 20 to 40% of your portfolio. Yes, you might miss late cycle gains, but you will have ammunition when assets trade at generational discounts. Consider basic protection. Simple SPY. Puts dated 6 to 12 months out. Insurance costs money. But losing capital in a crash costs far more. Most importantly, prepare your Stage 4 shopping list now. Identify the companies with durable earnings, low debt, strong cash flow, and products the world will continue to demand. When they fall 50% or more, emotions will tell you not to act. Every instinct will scream that the world is ending. That is precisely when generational wealth is built. The 4 stages shaped 1929. They shaped 2008. And they are unfolding again today. You cannot stop the pattern, but you can choose whether to be crushed by it or to use it. Stage 3 is nearly complete. The window to prepare is narrowing. The crash is coming. The opportunity of a lifetime will follow, and only those ready to act in the darkness will emerge on the other side with everything.